As has become a bit of a tradition in this session, chat is open. We'd love to hear from you, where you're calling in from, tell us about your company. No novels, no pitch decks, but tell us where you're calling in from. This is always fun to see the global reach, both of Silicon Valley Bank and AngelList coming together to share this insightful data. So jump in to the chat, please. Let us know where you're coming from, and we'll wait until the steady stream tapers off and kick this off. We've got Boston, New Jersey, Mesa, Arizona, North Carolina, Washington State, Singapore. There we go. We got our first over the seas. 15 minutes from Tijuana. Eric, I like the disclaimer. Awesome. Lots of folks. There we go. Hawaii. Ooh, Vail, Colorado. Loving this. I'm sitting in Palo Alto, California. I won't put it into the chat quite yet, but with that, oh, we got a Philly fan, Ruff, sitting in Palo Alto. You just had to throw it in there, didn't you? Great. Well, we'll go ahead. We're 2 minutes in. There's a lot of amazing content, so I want to be sure that we save time for that. Hello, everyone. My name is Lewis Howard, head of startup banking here at Silicon Valley Bank. Super excited to have everyone join us today. We have what is now, I think, our second year, so maybe our eighth or ninth installment of the State of the Early Stage Venture report that SVB and AngelList have come together to do, to really provide a perspective of unique insights into what's happening in the market, utilizing data that both of our platforms really kind of have in a very special way, right? AngelList being a market leader in the transaction data from what's happening in investment rounds, certainly something top of mind to everyone right now, and SVB having not only transaction data as well, but in particular, kind of how are startups reacting? How are they spending? What are the trends we're seeing? What sectors are we seeing activity and growth and maybe even some decline? As we all know, we sit here in early 2023 with a lot of change. The venture ecosystem over the last couple of years has been on a wild, wild ride. Great highs, some lows, but if you zoom all the way out and look at it, the trend of the innovation economy is still absolutely the most exciting place to be. And so we're going to hear today from some of our leaders, Abe Othman, head of data science at AngelList, and then two of our leaders from SVB's side, Kristen Kraft, our director of evangelism in the Boston market, and Liz Cahill, who's a senior market researcher for us here at SVB. And so without further ado, I'll turn it over to the team to really dive into the data. Before we go on too far, chat is open. Love hearing where people are calling in from. We are always open to questions. Let's keep it respectful. Let's keep it insights driven. We'd love to hear from you, and we'll try to answer as many as we can, both in the chat, use the QA function as well. And the final housekeeping, sharing a deck. Yes, we typically share insights. The report itself, we'll drop some links. You can go download that. All the info that you're going to see on these slides are in the amazing report with a whole lot more. So be sure to go download that, take a look at that. And then we typically circulate recordings of these sessions a couple of days after we're done. So with that, Liz, Abe, I will pass it over to you, Kristen, as well. And excited to sit back and listen and learn. Thanks, y'all.
Awesome. Thanks, Lewis. The special thing about this report, everyone, like Lewis said, is we use proprietary data from both of our platforms. So it's real-time information that you aren't going to find reported by any other sources. And it's tailored specifically to the early stage. On the SVB side, we're using data from companies that are pre-Series A. AngelList goes up to about Series B in a lot of their data, but we really break out that early stage to include pre-seed, seed, and really have that laser focus. So kicking us off is going to be Abe Othman from the AngelList side, who's their head of data science, and he's going to be presenting some insights from the AngelList platform. And again, like Lewis said, feel free to chime in on the Q&A and in the chat. So Abe, I'm going to hand it over to you.
Good morning from Seattle, everybody. Yeah, it's such a pleasure and privilege to be doing this again with all the folks from SVB. This, as the report in January 2023, it is both a review of the fourth quarter of 2022 as well as a review of the entire year 2022. So as we go through some of these numbers, you'll see both quarterly numbers as well as annual numbers as they seem relevant to the information. So I would say overall, the story about what happened in 2022 from the Angels perspective, where we sit, being essentially the world's largest early stage investor, working with hundreds of GPs doing thousands of deals a year. What we are, the way that we can analyze behavior is that the first quarter started very hot, as well above kind of seasonal norms. We put the peak of the venture market in February, and then after February was pretty much an unprecedented decline in our data. So the one of the figures that we track, we call it tenor or positive activity rate. So of all of the startups, at this point, we're at nearly 12,000 that we're tracking. So of all the active startups that we have seasoned investments into, so at least 6 months old at the start of the quarter. So these are companies that we would expect could change their value. We, some fraction of them will change their value. And what percent of those value changes on a price per share basis are markups versus markdowns, where we include, exits up or exits down are counted within sort of positive or negative activity, respectively. And the rate drop, from the first quarter of 2022 of last year of 83% positive numbers to 63% in the third quarter. So really, we've never seen a drop that precipitous in the, I think, 6 prior years that we've been doing this data. And then we saw a slight recovery in the fourth quarter. And so when we look at some of these, I said that this is both a quarterly review as well as an annual review. One of the things that we saw from looking at the annual data is that it tends to, if you average over this excellent first quarter, this pretty good second quarter, this terrible third quarter, and a little bit of recovery in the fourth quarter, you tend to get numbers that look sort of average. But that's not really the story of what happened in 2022. It was a very sharp drop followed by maybe a little bit of recovery. So I think the next slide will help us go in a little more detail about what we saw. So what we track are 2 dimensions in each quarter and also on an annual basis. And those dimensions are tenor, which is percent of positive activity. And then that's the x-axis of the plot on the right. And then that's the y-axis of the plot on the right. And the x-axis, the horizontal axis, is activity rate. So the fraction of these 12,000 companies, how many actually did go through evaluation change. And one of the things that is typical is that if you see a higher rate of activity, it typically comes at a slightly worse tenor. And so there's, historically, before we started doing this in 2020 and we started seeing really weird numbers, there was kind of a line running on the right plot there. There's kind of a line that runs northwest to southeast, which is all sort of like equivalent typical activity. And what we saw since 2020 is kind of really aberrant activity. Like, 2021 was characterized by extremely high rates of activity that were extremely positive. And then what we saw in the third quarter was an extremely low activity rate that was fairly negative. And so these are kind of the statistics that we track. One of the most interesting things is that if you chop up activity this way, so you have an axis for tenor and an axis for activity rate, the fourth quarter of 2022 actually ended up almost equivalent to the second quarter of 2020, which was the first kind of quarter where that was like the pandemic shutdown quarter. And so it is really, it's interesting to see, like, I mean, those 2 dots are literally almost on top of one another on that right plot. So like in terms of when you think about what was the quarter like, it was like what we saw in the second quarter, where startups were panicking when everyone was panicking, when everyone started working from home, businesses were shut down. That's where we're at again in the startup ecosystem, which I thought was that was the number one thing that I saw when I ran these numbers. I was like, wow, that is really remarkable. What we saw, it's worth noting, what we saw coming out of the second quarter of 2020 was a really sharp recovery. So the number of deals, what we saw was the rate of positive activity started just flying upwards, but on relatively low deal counts. And then we saw a ton of positive activity. Follow after that, which kind of led to the excitement of 2021. I'm not sure that I would say that, I don't know what the future will hold. This is not investment advice, but I think it's unlikely that we will see a similar recovery after this quarter. But I don't think that's a story that will repeat itself. In terms of what we're thinking about for the upcoming year, we believe, and we're going to have a blog post about this soon, that venture activity will probably remain depressed throughout this entire year. But it is something that we're tracking, and it is worth noting that we have literally been at this level of activity before, and it was the second quarter of 2020, and something happened after that I don't think is going to happen again. But of course, it has once, and it might again. Let's see the next slide. So one of the most interesting points has been, especially at the early stage, the resiliency of valuations. And what we mean that is that, so on a quarterly basis, we saw for the first time declines in the pre-money valuations, but on a year-over-year number, those valuations remain robust. And so literally in 2022, the average pre-money of both pre-seed, seed, Series A and Series B, those valuations were higher than they were in 2021, even though 2021 was very exciting. I think that there is a bit of although we did see for the first time valuations start to decline again in the second half of the year. So we are seeing a little bit of pullback from these numbers. So this is a place where the annual numbers may obscure some kind of valuation trends here, where, if you average this on the whole, it looks like there was a small increase. Really, it went up in the first half of the year and pulled back in the second half of the year. And I also want to bring up, we have these rounds called pre-seed and these rounds called seed. One of the factors that is driving the continued increase, you can see the seed pre-money is a typical seed. I think actually the next slide has the quartiles. Is that right? Yes. So these are the quartiles, the median valuations associated with these rounds. You can see now that so for the first time again, the median seed pre-money has gone from 20 million, where it was throughout 2021 and the first 3 quarters of 2022, down to 18 million. But the phenomenon but pre-seed remains at 10 million pre-money. What we've seen is actually in our data, which is not on this slide, but what is the difference between a pre-seed and a seed round? Well, one difference is that some seed rounds get done by priced equity. Virtually no pre-seed rounds get done with priced equity. A minority of seed rounds get done with priced equity. Aside from that, there are no real differences between pre-seed, like a round called pre-seed and seed, besides valuation. And so what we are seeing in our data is actually more, so a round with a 10 million pre-money, which maybe 3 years ago would have been called a seed round, is now almost universally called a pre-seed round. And so some of the resilience that you're seeing in terms of seed and pre-seed valuations is a function of the changing labels of these classes. So that, and what we are actually seeing is more pre-seed, more deals that are labeled pre-seed that have valuations in this pre-seed range. I do think that valuations still have a ways to fall, but that in some sense, the fall in valuations has already been obscured because of the label mix changes between pre-seed and seed. So when you see numbers like this, it's not that some of the fact that pre-seed and seed valuations haven't fallen much is because there are more higher price deals that are being classified as pre-seed, which both removes the lower value deals from seed and increases the number of higher value deals for pre-seed. And so that's really what we think is happening in terms of some of the valuation robustness in the early stages. So I know there is kind of a popular web meme about, oh, the shoe's going to drop, the shoe's dropped on late stage. I mean, look at the pre-money median for Series B rounds, right? It went from 250 million at the start of this year down to 125 at the end of the year. Why haven't early stage valuations fallen? The other shoe's about to drop. I do think that they will drop a little bit. We did start to see seed median decrease a bit. That said, the composition changes and what we classify as pre-seed versus seed, I think, are masking a huge part of that decline. So I don't think that that they will fall as much as people suggest. Like, I would not expect a 50% drop in these valuations. I would instead expect significant changes in the composition of these rounds. And we're now at a point where, if you have an $8 or $10 million pre-money valuation, that round will always be called a pre-seed, and it's never going to be called a seed round again.
Abe, can I ask just a couple of questions while we're in flow here?
Yeah, certainly.
Come through the chat because they're related to this. You touched on a little bit from size and type of round, but any detail related to existing investors, so down round, flat round, follow on versus net new investor participation in this data?
That's a really good question, actually. I don't have that on my fingertips, but it's something that that's a really good.
I think it's a great call out and insight for the overall trends of what's dragging it down. Is that existing companies that hit a valuation overhang that's being corrected because they're out of cash, or is that just general trends and sentiments in the market? And then there's a technical question. Pre-seed seed rounds are not priced. What are you using for valuation? Note cap?
Those would be safes.
Yeah.
So the cap of the safe or the convertible note, and this excludes uncapped deals. And so this is kind of where there's something, either an explicit, equity has an explicit valuation, or the cap of a safe or a convertible note, and excluding everything that does not have some tied evaluation within the instrument. I do think, just because it was brought up, the flat round thing, I think that is actually a hole in our methodology, is that the methodology we're discussing about, positive versus negative and activity rates, flat rounds are something that does not flat rounds headline, which are often, from a price per share basis, because the additional dilution will be actual down rounds for investors. Yeah. Everything we do is on a price per share basis. It's one of when Liz was like, hey, this is like proprietary data, like we have price per share valuations for all of these startups that get updated, very quickly, because we're on the cap table. So, a headline flat valuation is something we see as would actually show up as a negative. But for flat rounds on a price per share basis, those would not show up on our charts because, from our perspective, the price per share hasn't changed. So that is I just want to call that out because you mentioned it, Lewis. It is a hole in our methodology. It is something we'd love to sort of know more about, but it's tough. Like it's not like we have a portfolio of like 50 companies that we're keeping close to, like, sure. The portfolio is enormous and has a bunch of, whenever you're dealing with 12,000 companies, there's a bunch of weird edge cases. And so this is the methodology that we have that I think captures it globally. But if you're asking about, how many companies have done like flat rounds in the past 3 months, like we don't have that at our fingertips in terms of this study. And we might be able to get it, but it's not something that shows up immediately here.
Yeah, I think just generally, I totally agree with you. Generally, I think that the sentiment is lots of founders saying, where should I be and what do I need to look like, right? Less of the like, okay, the data says this, but it's more of, okay, how does this impact me and what does that look like? And I think those are the pieces where general trends, and as we talk about spend and as we look at runway and some of the other things, it helps create that narrative. There's no one right answer that is going to say, oh, if you're pre-seed, then it has to be this. It's going to be different. But the trends here are far more important than the one-off data here and there.
I will say that in terms of new investors, right, pre-seed and seed rounds tend to be sort of fresh actual new startups. But again, the composition of those rounds has changed so that really like what qualifies as a pre-seed or pre-seed company may actually, one consequence is that may actually look a little bit more robust. Like that might look a little bit more like a seed round company in the past. Like maybe it has revenue, maybe it has employees, maybe it's not, 3 people and a slide deck anymore to achieve that $10 million pre-money valuation. And so I think that is worth calling out, and it is something where if someone's going out and raising money and hearing from investors, kind of this looks more like a pre-seed company, that might really be more about valuation, which valuation might be actually like fairly reasonable. I remember when I started my first company more than 10 years ago, and it was we had a seed round that was priced at I think we were at $10 million, and it was like our lawyer was like ecstatic. He was like, that's a great seed round, guys. Like he was very, very excited about the valuation that we got. And now, of course, that's the median pre-seed. So I think there is a sense of the labels that we use for things have changed a bit. And I think also, but the underlying valuations, I think, and hopefully there is some mapping in company success. And really, I think just want to emphasize this: the only difference between a pre-seed round and a seed round is that some, call it 20% of seed rounds, get done with priced equity, and that's it. These are amorphous classes that don't have any like hard built-in definitions. AngelList uses the combination of what our GPs on the platform label a deal as well as the venture associates that see, thousands of deals a year label it as. So it's kind of like, but it's not like there's a book that's written somewhere that says a pre-seed deal looks like this and a seed deal looks like this. These are very, very flexible labels. So I just want to really emphasize that as being a nuance that might not be seen from just, if you just see a screenshot of this table.
That's right.
Great. We can go on to, so these are, I think, one of we were looking at both quarterly and numbers here for deal sharing capital deployed. And I think I really wanted to share this chart in particular with the group because I think it really illustrates the pullback in fintech and Web3. I think, these are categories where, and I think we'll actually see on the next slide as well. These are categories where that used to have an even larger share, and there has been a pullback. They're still very popular. However, there has been a pullback. I think one of the things that's interesting is, or that may be unexpected. So, in line, like just a few call outs on the sectors here. We have not seen a huge flood of deals in areas that you might think in the fourth quarter would have picked up. Maybe we'll see in the first quarter, and those include AI and ML, as well as clean tech. These are, which is the sort of our general label for like green or lower carbon investments. You might expect those sectors to be more represented, and maybe they will be in the first quarter, but we didn't see that in the fourth quarter. On the other side, we saw a lot of, especially from the perspective of, trends back to onshoring. One of the easiest sectors, or the clearest case that can be made, I think, for onshoring in the US is aerospace and space in general. And that saw a huge fraction of the capital deployed on platform. And finally, I just also want to point out, one of AngelList's historic strengths in terms of like the GPs that we work with and the capital accessibility has been to real estate startups. So to see real estate that small is an interesting. I think it's sort of like the dog that didn't bark to see real estate that far down. There have been prior quarters where real estate's a top 3 market segment, and now it's like way down at the bottom, which I think is interesting. And I think the most interesting though for trends is to look at the annual numbers by market, which is the next slide here.
Can we pop over? Yeah, let's see that.
Excellent. So we have so this is deal sharing capital deployed. How these numbers could diverge is size of deals. So if if there's like a really, I'm not sure, honestly, I don't know which one is like more accurate for the sector, because if you ask about, if you're doing number of deals, it might be influenced by a large number of like new startups. If you're doing size of deals, it might be influenced by like a single mega deal that was on the AngelList platform. So it's hard to say like which one of these is more accurate. I would sort of imagine kind of synthesizing these in terms of what we think of as the categories. So in 2022, though, I think we began to see a little bit of the pullback from Web3 and the introduction a little bit of AI ML, as well as health tech has been fairly resilient as well in 2022. So I think that's I would expect for 2023 continued pullback in fintech and in Web3, and probably more deal flow to AI ML. I think in general, some of the other labels that you see here, and I think I've seen this in the comments, things like SaaS or enterprise, I mean, honestly, those are almost like generic startup labels. We do have like, and there are, of course, like a lot of businesses that fall right on the line between what you would call SaaS. Like if you're selling an enterprise SaaS product, will you be classified as enterprise, or will you be classified as SaaS? Like I can't tell you. And it could be the companies themselves sort of picking which label they think better defines them. But those are kind of I would almost describe that as kind of the generic or like the placeholder startup name. So it's more interesting to see kind of what are the other labels that are emerging either at the forefront or pulled back, and over what span. So, over the past 5 years, seen this huge kind of burst of fintech becoming kind of the #1 sector. And my prediction for 2023 would actually be that fintech is sort of no longer the #1 sector represented for AngelList startups because of the pullback in fintech valuations. So
travel in 2019, and then it just disappeared.
Yes. What happened to travel in 2020?
I know. Big question there.
And with that, to discuss and go into more detail, I mean, nobody has better data on what startups are spending money on and what sectors than SVB. So I'm going to hand things over to Liz and to Kristen at SVB.
Thanks so much, Abe. That was fantastic. Let's see. Hopping on over to our spend section. So at SVB, we bank thousands and thousands of early stage startups. And the really cool thing is we can look at how they're spending their money. We have some really great internal models that categorize that spend by depending on the vendors that are underlying that spend. And also we have a taxonomy for our startups to group them into sectors. And we even go much narrower, but for the sake of the sample, we keep it fairly broad here. So when we're looking at early stage companies, they are all companies that sit in our startup banking division, which Kristen and Lewis are part of. And I support with a lot of data. And these are companies that are pre-A. Once they've raised an A, they kind of graduate into another banking group at SVB. So these are all pre-A companies. They were all, I sliced them so that they were all founded before we start looking at this data. And they've all been with the bank before we start looking at their spend data. And we are their primary bank. So I want to get the most complete picture of spend. And then I also refine the sample a little bit more to take out any gaps. So I look for companies that have consistent spend. At the early stage, as you know, as H mentioned, it could be a few people in a PowerPoint and they're not really having a lot of spend yet. So we want to look at early stage companies that are somewhat business as usual, humming along, doing their thing. And we really saw spend growth really peak in Q2 2022 across the board. And it's been on a slight decline to almost flattening ever since. In Q4, we didn't see a massive drop off, but we definitely did see folks cut back and spend growth flatten. And I do think that's significant because these are very early stage companies. So they are growing very fast in theory. So they would be spending a lot more as they grow rapidly. So to see them pull back any spend or even flatten spend is a big deal. But this is also in line with advice for investors to conserve runway in a tougher fundraising environment. So it makes sense. It's really interesting to see this data alongside funding data and see that, hey, valuations are flattening or going down. Less deals are happening. Startups are cutting back their spend.
And I think it's noteworthy that, there are certain industries where it's easier to cut spend than others. If you are building a hardware solution, you're a frontier tech founder, your cogs are what they are. You maybe get a little bit scrappy there, but you're not going to necessarily have the same amount of flexibility as somebody in the enterprise space, let's say. So just remember, every industry is different, every founder is different, and keep your eye on the prize in terms of what is going to drive revenue for you within your industry and your company.
Yeah. And at the early stage, I think it can be very painful to cut spend because, everything you are doing is pretty necessary. So, every spending cut is potentially, taking a bite out of the business itself. So you have to be very judicious. And popping over to payroll spend, and this gets a little bit lumpy because early stage companies, as we see later on, often hire a lot of flexible talent. So this can be a bit bumpy, but we did see things generally drift downwards between Q2 and Q3. Again, Q2 was kind of that peak. And then we did see things tick up a little bit in Q4, but that can be also folks paying year-end bonuses and also folks paying severance packages. It's not necessarily new hiring. It could be other forms of payments. And I would say this payroll data represents W-2 payroll. It doesn't, or if it's contractors, it's other forms of income, but this doesn't account for equity compensation and other forms of compensation early stage companies give. That's on paper. This is strictly money that companies are spending on certain vendors that have been categorized as payroll providers. So these are median numbers. These are teams that have like a few employees. I know for some folks on the line, they might, you might not be paying anyone yet. You might not be at this level, but we do look for early stage companies that are pre-A that are paying folks a minimum with some regularity.
And one sort of actionable thing for, all of the founders who are joining us today to think about is, how can you still accomplish your same goals without FTEs, or maybe without as many FTEs as you would like? We see so many of our startup clients turning to teams and companies like Bolster for fractional hires or hires that can help on a contract basis with a really high priority initiative. So, even if you are trimming on payroll or not hiring at the pace you might like, there are options there, and we're happy to help you think through those options.
Yeah, absolutely. And the next thing we look at is, anticipated kind of revenue range. And again, take this with a grain of salt. Every company is going to be very different. And at the early stage, this can be pretty lumpy. But we look at basically money coming into the accounts of our early stage companies. We can take out funding rounds. We can flag those. We take out, other forms of like refunds. But there are very few reasons that people give companies money. It's mostly they are investing in them, they are paying them for a good or service, or they are getting a refund. So we do look at companies that have some revenue. So many companies are pre-revenue. We don't include those here. We look at companies that do have some consistent amounts of cash flowing into their accounts that's been tagged as revenue. And it's not the same as like GAAP, reported revenue, where in accounting terms, you might report revenue before it actually hits your account. You might, if you have a contract, you might say, oh, we're going to report it for this quarter. This is strictly money that's coming in for early stage companies. And you can see sectors like fintech has a super wide range, but has gone down since Q2 and of 2022, or the second half of the year. And that is, hey, the markets have been going down. So it's, it's almost, mirroring the markets exactly. If you are a startup that, helps folks invest their money, or we've also, if you're a lending related business, you've seen, interest rates go up and markets also go down at the same time. So it's been a tough spot for fintech, whereas other sectors are a little bit more flat in this space. And then the next section we do is we look at some of the top vendors within our spend categories. And this is really interesting. We did this last year too. And One of my favorite things that I noticed was that TikTok went from last year, it was number 7 and now it's number 6. So we're starting to see more companies get on TikTok to advertise, which is pretty interesting. I know there's some talk about potentially having it be banned. There's a lot of tension around and conversation around TikTok right now. But on the payroll side, we're also seeing, places where people can get fractional or flexible talent, such as Upwork and Fiverr, continue to be popular. These were also popular when we ran this last year. And looking at computing, we see AWS is the main cloud provider for most early stage companies, but followed by Google Cloud. And this is just in terms of popularity. So number of companies using these vendors. It's not spend quantities, because that could easily get skewed by 1 or 2 companies spending a particularly large amount of money. We just want to look at popularity in terms of what vendors early stage companies are going with. And then operations, we definitely see Google Workspaces being really popular, actually above Microsoft Suite. So I think that's pretty interesting.
And 2 pieces I'd be remiss not to touch on. One, so many of these vendors are partners of SVBs, and we have great discounts, freebies in place for SVB clients. So if you are not a client, come on board, take advantage of some of these freebies and discounts. And if you are a client and you're not yet taking advantage of these, or you need to, look into new types of solutions, let's talk about it so we can help you save some money. The second piece I just want to touch on quickly, as a former growth marketer myself within B2B SaaS startups, I think that the name of the game right now is resilience. You want to cut costs in places where it's not painful or less painful, and hopefully going to have a minimal impact on your long-term success, while continuing to spend on the things that really are going to influence those metrics that investors want to see, and that will fuel your long-term growth and success. So for example, on the advertising side, we've seen so many founders within our portfolio trimming on ad spend. If you have been throwing money out without really any sort of metrics on ROI of that ad spend, great. That's a great spot to cut. If on the other hand, you are generating revenue, you're seeing a really good CAC to LTV ratio, don't trim that ad spend. So again, resilience is what we see the best of the best in terms of our founders going for when it comes to their spend and their cuts.
Yeah, that's a great point. And also the fact that, hey, if you are trying to cut costs, we do offer a lot of discounts on a lot of these providers. So that's a good nugget. I know it's 2022, especially the second half was a pretty tough year, but I did want to end on a somewhat cautiously optimistic note, but I found this to be really interesting. Looking at dry powder, we know we have record dry powder in the VC ecosystem, and if you're a founder that's struggled to fundraise, you might be like, okay, so what? I've struggled to fundraise, record dry powder, great. It's not being deployed at the moment, or it's being deployed more judiciously. But what I did notice was an uptick in dry powder that's specifically earmarked for the early stage. And I pulled this data from Preqin, which is a great data provider that tracks fund data. And, there might be some, and probably a lot of early stage investments that will happen out of, general venture capital funding. But the fact that there are now more funds than ever that have been earmarked specifically for early stage, I think that is worth noting. And it's grown a lot faster over the past year than any other segment. Last year, Bessemer raised one of the largest VC funds ever, and it was specifically for early stage. So I think that's great. We do see this trend of, hey, later stage companies have raised super high valuations over the past few years, and that feels a little bit unsustainable in the current market environment. So there's they might have to take some valuation haircuts. The public markets are struggling. So those later stage companies are being comped to public markets because that's, in theory, their next step. But early stage companies don't have that, as they're going to be private for much longer. So investors are thinking, okay, these companies are going to be private for 10 to 15 years. The current public market environment is not, as relevant to these companies. So we want to make sure they have enough fuel to grow. So I think that's nice that we see more funds specifically, raising vehicles earmarked for the early stage. I think that's pretty cool.
One thing that we've heard from a lot of, as Liz was talking about, so many great funds focusing on early stage. One thing that we continue to hear from VCs who are focused on early stage is that increasingly they're looking for a lot of those traction metrics that used to be focal points for later stage investors. It used to be the case in 2021, let's say, that raising money when you were pre-revenue, maybe even pre-product, was feasible. That is no longer the case. Even at the early stage, the best investors, they want to see those revenue metrics. They want to see, customer retention metrics. They certainly want to see a working product. So even though, this pool of dry powder is so much larger on the early stage, which is amazing. I think that the rules have changed a little bit over the past couple of years in terms of what they're looking for. So again, like eye on the prize in terms of those revenue metrics and traction metrics.
I just want to point out that that's very well aligned with what we're seeing with the AngelList data on valuations, where essentially kind of the as seed valuations and pre-seed valuations have essentially doubled over the past couple of years. That there are increased expectations, but there's also increased valuations for founders that come along with that. It would not be surprising to me if there were in another couple of years we're doing this and we're talking about, I don't know what comes before pre-seed. Angel, there's some new kind of round that's earlier that fills in for $5 or $6 million pre-money valuation and really is 3 people on a slide deck and no progress or something. Like that would not be surprising to me. There has kind of been a sort of gradual shift where the labels have all kind of grown later. And I do think that also kind of encourages, I think that's wonderful for the diversity of the startup ecosystem. It's really great that if you had to start a startup by raising, $15 million from a venture capitalist, something like it, the pool of folks who can do that is pretty narrow and restricted. Whereas if you can start a company by raising, $1 million, that's still a very difficult task, but the pool of folks who can do that is larger and more people will be given the opportunity to do that. So, but it would not surprise me if, there are still companies that do not have great metrics that with the proper venture funding will get to those metrics. Are they being well served by GPs currently within kind of the $10 million or $12 million post-money valuation range? Perhaps not. Does that mean that there will be a lot more startups that are raising money lower, and will that get a new round name? Perhaps. Part of me hopes from our own data analysis perspective that we don't need to introduce a new round name into our data because it's going to make everything harder. But I would not be shocked if that was a consequence of what we're seeing.
Yeah, I've actually been looking into something called like a startup studio or a venture studio, which is basically an entity whose job is to incubate new companies and build them from the ground up in-house. So we might see more of that coming down the pike. And I know a lot of later stage VC funds have actually gotten a lot more curious about incubators and accelerators and have wanted to get into these organizations a lot more actively. So definitely some interesting stuff happening at the early stage. I think now is like the quest to get in like as early as possible. You get the best prices, you get, more ownership. So it's a very attractive space, especially as the late stage has struggled. And then I want to pop to our last few slides. I just want to flash them up really quickly. We have some really great quotes here from investors that AngelList has great relationships with, who gave us some predictions for the year to come. So I know Sean was talking about how hey, a lot of growth stage startups are going to die. That's not great if you're a growth stage, but again, I think it instills hey, at the early stage, things are a lot more comfortable still. And talking about, hey, it's going to be a tough year. A lot of people are talking about focusing on cutting spend, being responsible with money you have, having metrics. So I think that's some of the tone of the quotes. I really like this one. I think we'll see the hangover from 2022 continue through the first half of next year. So, and then there's also a shout out to mission-driven founders. So I think those are some great quotes. You can read all these quotes, within the report. And there's a lot of great wisdom there. So I
One
think
of the, oh, sorry, one
Go
of the
for it,
blog
Abe.
posts related to this, yeah, one of the blog posts that I liked, this is kind of a year in review, that I liked that we did the most in 2022 was because I just like being able to talk about this is how much money you lose when startup investments go bad. And I think one of the things that we saw in our data, which surprised the heck out of me, is that if you put money into a growth stage investment, we're talking Series C or later, and it is marked down, the markdown is on average more than 50%. It's like the typical loss on a growth stage investment that goes bad is like a 60% markdown. And so I think one of the things that we started to see in 2022 was that I think there was an environment for several years where growth stage investors it was pretty easy to make money in the growth stage.
Yeah.
What are the companies that have the most popular names, and paying any price for those companies seemed like a really good idea because they're going to IPO and, you can offload it on the public markets. I think that a lot of those investors, particularly kind of crossover investors that were more typically used to the public markets, were not and continue to not be particularly, capable of handling, an asset class where if you lose your money, half the time you lose half your money, and the other half the time you lose, 90% of your money. I don't think they're well geared for that. That's not the kind of assets that early stage investors don't like when that happens. I never like to get an email about, a startup I've invested in winding down, and there's, if I put $5,000 in, I'm getting like, $10 back. It's not a great, I don't like getting those emails, but I know it's part of investing in the early stage. For later stage investors, I think those kind of losses are not something that they are particularly well geared for. And I think on the whole, one of the things that we learned in 2022 or saw in 2022 was that, growth stage investing is really has an interesting flavor of, it's not public markets investing with a little profit kick. It looks a lot more like early stage investing than public markets investing, and that I think a lot of the folks who were driving up growth stage valuations maybe were sort of unprepared to see that. I think it's one of the things that we saw last year.
Yeah, when everything's up and to the right, it's easy for any fund to look great. It's easy for all these investments to just look great, and that encourages people to take more and more risk. And then, of course, the blowback from that is more, pronounced in an environment like this. I saw some great questions in the chat about, perspective on fundraising in a recessionary environment. And I just put out a thought piece with SVB talking about this. And I mean, Abe and anyone else, feel free to chime in. And if people have ideas, actually, if you want to post ideas in the chat, I know we have a fantastic audience here. So if you want to put in any of your own strategies, that would be fantastic. But something that I've really seen in my research is showing milestones and metrics. Like, I think that's really important, to say like, hey, like we're going to use this funding for this, and this is what we're going to do with it, having a plan for it, showing what metrics you have, showing why you need this funding. I think that's really important. I've seen a lot of guidance around that. And also, maybe not as relevant for the later stage, but be thoughtful about, hey, you might have to take a down round or a flat round. That can be really complicated for your cap table. So be very thoughtful about that. Instead of raising equity, it might make more sense if you can get debt at good terms to use debt instead. Or you can talk to existing investors to see if they're willing to do a follow-on round. I think those are some strategies that I've seen that make a lot of sense to me. And I've talked to friends. I have not personally raised money for a startup, but I have a lot of friends. I'm in San Francisco. I have a lot of friends who are in the community, and I always am asking around. I'm always trying to keep my eyes and ears to the ground on what's going on. So those are some really important things. Also, if you're in a space that is really, I think, like getting a lot of interest, it's not going to be as tough of an environment. My partner's in climate tech, and there's a lot of interest in that space. And there's even philanthropic entities. If you're like a mission-driven company in the climate space, for instance, there are like philanthropies that run similarly to venture funds that are usually a lot of tech folks coming together to give back to science and technology. So if you're a climate startup, there's interesting avenues there. There's also government grants as well. There's a lot of stuff from the DOE out there if you're in the climate space, and including special lending available. So look at all of your options, like look at the space you're in and think about that. If you're, an underrepresented founder, there's also potentially specific vehicles earmarked for that. So you can kind of look around and see, what niche you can fit into that might be a bit more attractive, if there's a way to really differentiate yourself that way.
Well, another tip or something that we're seeing at AngelList is, in terms of runways that your fundraising round will guarantee, it is sort of better than ever now to be able to tell your investors, hey, this is going to set us up for at least 18 months of runway. Because I think, if you have a bridge or something that's only in the last 6 months, like it's worrisome to investors, like, well, if we're not out of this in 6 months, how do I know that, this is not, that we're not just kicking a can down the road? Whereas if you say, hey, we've got 18 months of runway after this round, I think most investors would be like, okay, so if you're going to raise again in a year, I think things are going to be probably a little bit better or more, happier, more salubrious in a year. So let's go for this. So I would keep it really, I don't recall there being as much attention paid to runway by investors in the past, where there's this idea of like, well, you can always just go and raise another round and that's going to be fine. Now I think it's a sense of like, if you only have, a few months of money in the bank, that's really worrisome because the sense is that if things don't sort of repair quickly, it's just kicking the can down the road.
Yeah, absolutely. And I know there was some chatter about crowdfunding and, Reg CF. There's now more, structure around crowdfunding and how folks that participate in that get equity. I see crowd funds happen a lot in like the VR space, like certain spaces that have big communities of enthusiasts. So VR, I think, has always, even from the first like Oculus dev kits, have been crowdfunded, but also you see all these VR peripherals, like, omnidirectional treadmills, like really, really niche VR products that like the hardcore fans really want. Folks will crowdfund around that. I've seen that be really successful in the VR community. These aren't like massive amounts of money. It's usually just enough to get like a prototype out and get a product to market. And it's usually firms that have done it a couple times before. But I have not seen, say, like an enterprise SaaS company crowdfund. Somebody please drop in an example if you've seen that. But usually it's more stuff that like, it's more like consumer focused. I've also seen a lot of over the years, I've seen like products crowdfund. But again, like not like, I've never seen like a health tech company crowdfund.
And I think just because Liz, you mentioned AR/VR, and I know it's come up in the chat a bunch. For what it's worth, AngelList does not see many AR/VR deals. We do have that market tag, but I just looked at the data and it's like about 5 deals a quarter.
It's still a very niche space. Something interesting, I know last year and the year before, there was lots of talk of Web3 and metaverse, and VR, AR was slotted in as a component for that. So it was getting a lot of attention. And there are some fantastic use cases for VR and AR, and it's very specific. So it remains a very interesting niche. I love the space. I just wrote a blog on it. It's a fascinating space. But it's much more, you have these like it's a very niche thing still, outside of like some gaming and like medical and enterprise applications. Let's see, I know I was checking out the Q&A here. We have a company that's trying to figure out what their valuation they need for the next round is. I'd say like in terms of like your specific valuation, I'd say it really is very company dependent. You don't want to raise a valuation like, I think in the past couple of years, we've had companies raise, huge valuations and have just taken large amounts of money at a very big valuation. And it was perhaps not a valuation that made sense for a company at that stage and was an amount of money that a company didn't necessarily like have a plan for how to spend. That was very 2021. I was talking to someone at a party recently and they said that exact thing happened to their company. Someone just knocked on the door, offered them a massive amount of money, and they got a huge valuation with that. And then they're happy they have that money, but they're struggling, to think about, okay, will they be able to grow into that? So I'd say it should definitely reflect what you'll be able to like realistically grow into by the time you need your next round. You don't want to go too high.
Yeah, I think that's a good way of thinking about valuation, Liz, is like, your investors of this round will want to see, well, can you construct a world where, you execute really well, and I, as an investor, will see, a 3x return in 24 months. So I think, it almost might help to think about really your trajectory kind of, let's call it 3-4 years from now, and your valuation in kind of 2 fundraising rounds, and what's the trajectory? At that point, you're really talking, probably you can look at metrics and get reasonable comps and figure out like, okay, hey, this is an investment that would be, I know that at this valuation, I think it becomes an attractive investment. At this value, at this lower valuation, it's an extremely attractive investment. At this maybe higher valuation, it's maybe a little bit less attractive, but a justifiable investment. And if you have those numbers in mind, I think it'll help in terms of thinking about the valuation. Yeah, just put your investor's hat on and say like, what's the case that I can make that this thing is going to be worth significantly more in 24 months at whatever price is. And I do think, price is a lever that is, that can flexibly adjust. It's the joke that all problems are pricing problems. And I do think there is an aspect of that happening here. And I would not be surprised, honestly, to see much of the inflation in valuations that we saw in 2020 and 2021. It started to pull back in 2022, again, later stages more than earlier stages. I would not be surprised to see most of that run up kind of given back by founders over the next couple of years, with the caveat, of course, that I brought up about the changing mix between pre-seed and seed rounds. And I think that will be interesting to see. And it's, I think it would not be surprising as well to see a new funding round, maybe involving crowdfunding or even kind of smaller solar capitalists that starts funding companies at a lower valuation, call it 5 million pre-money. And that is something we could see in the next couple of years.
Yeah, things will definitely get scrappier. But, I think some of the best, we've talked about this in a lot of these other presentations and reports, but like some of the best companies are founded during times where there's like, you have to do less with more. And that leads to a lot of innovation, and you're spending thoughtfully from the beginning. So if you're a company that starts out in a very lush period of time, it can be a little bit harder to have that discipline. But, starting in a time where you have to be thoughtful about runway and metrics and, what's your path to profitability from the beginning, I think is a lot better in the long run.
Yeah, it's unfortunate, but it's very hard to go from an atmosphere where, growth at all costs, very profligate, very high valuation, high spend, to an atmosphere where, profitability starts to matter. And I think it's much easier to go from an environment that's kind of lean to one that it becomes frothy than one that's frothy and then going to lean. I think that's a very, very hard transition to make. And I do expect over 2023 that we'll see, more notices from companies kind of getting wound down on the platform. I do think that companies will need to go through a fundraising round to let what's happened even in the public markets in 2022 begin to be reflected in the startup ecosystem.
Yeah, absolutely. And I see some questions about valuations and safes and stuff. I would say definitely please check out the report. We have we're going to be sending that. I know the link has been dropped in the chat, and we're also going to be sending that out. Brooke's going to send out a follow-up from our team with links and everything. You can also find myself, Kristen, and Lewis on LinkedIn, and Abe you can find publishing some fantastic stuff on AngelList blog. So that's where you can definitely find us on the internet. You can check us out, DM us. And this has been super fantastic. I know we're at the top of the hour, so if folks have to hop, we're kind of closing out right now. And we will definitely share. I know some folks are asking for the link to the report. If you just Google state of early stage AngelList SVB, like Q4 2022, it should pop up right away. But also Brooke's going to send that out in the post webinar. So look out for that. This is recorded. So we'll be sharing this, and also the presentation replay will be available through that. So and people are asking for the slides too. These are just taken directly from the report. So you can hop into the report, and if you want to make your own slides, they're just screen grabs, nothing fancy.